Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead, the Halloween week. Good evening, Rob. How's everything?
Oh, pretty good. Quite a tragedy there in Seoul, Korea there with the Halloween celebrations gone bad, hey?
Yeah, it's like second time within a month. First it was Indonesia with the stadium, and now this. It's just
yeah, 120 people dead, I guess. That's quite substantial for a crush. But I guess you get every crowded, in a crowded area like that, and where there's essentially buildings and walls surrounding, there's nowhere to go. So yeah, pretty sad. Well, I'm not going out for Halloween, are you? I guess you have to take your kids out?
There's a family in town, they have a farm, and they do this cool haunted orchard thing. So you go through the orchard and the farm, and they've got people jumping out, and
Interesting.
They've got all the relatives dressed up and little werewolves with chainsaws. It's kind of fun. So it's a Halloween orchard walk on the farm in the dark.
Well, in some families, not all the relatives have to dress up, do they?
Yeah. Just show up as you are.
All right, well, let's get this party started. So we're doing this on Saturday night here because Sunday I'm not available. I've got to be out of town for the day. So we're going to do it Saturday. So we don't have the futures to rattle off what they're currently doing. So do make sure you check, check Sunday night, see how they're doing. And then it's a good contrast to check pre-market to see what changed and, to assess your overnight highs and lows, your pre-market lows and highs. That really gives you context for what's happening. A case in point would be like when we look at some of these earnings that have happened recently, specifically Amazon's, and see what happened after hours when they reported. I mean, it dropped substantially, and it was down at the 88.25 level, which is a huge haircut for Amazon. And it seems really quite amazing. I mean, because it's post split, and we're used to, remember for all those years it was like Amazon in the 2,000 to 3,000, 3,500 area. Now we're $88 for Amazon, but it came off that low after hours, and it was a really nice trend up. And then the following morning, it also kind of built on that a little bit prior to the opening. So that gave a lot of extra confidence to some of these tech stocks, and especially, Apple, which was already really stronger after its earnings. And the odd man out is this Meta performing terribly. I mean, do you have any interest in being in the metaverse, or do you like kind of hanging out with real people?
I have no interest. I didn't like Facebook as it was, and this is just getting weirder now with this metaverse.
Well, I mean, in one day it may work out, but they're going all in on it, and I don't know if investors are that happy. It's a big bet. It may pan out, but interestingly enough, when companies are in their prime and their growth rate is just incredible, they're unstoppable. And they kind of, hit a maturity, and then afterwards, their margins start shrinking. This is a common problem. But some of the big companies that have been are no longer around. And, maybe 4 years ago, people would have thought, well, Facebook will never come to an end. But, it's not impossible. And, their free cash flow has shrunk from the billions to only 178 million now, free cash flow. So I mean, if they didn't trim the fat, and if the debt, it needs to be addressed if there is, or just, the expenses are much greater than the revenue, they may be a company that is not here in 5 years. It's possible, So it's an interesting cycle, the whole sort of growth to maturity to down the backside when margins erode. When revenue decreases, when competition increases. It's an interesting cycle. Anyway, let's see what we got here. Let me rattle off a few things. So for the week, the Dow Jones was up 5.7%. NASDAQ was only up 2.2. So we see a real kind of hesitancy still to go all in on these tech stocks. S&P 500 was up 4%. Now bear in mind, S&P has financials in it where NASDAQ doesn't. So even though the S&P has technology stocks, it's not, quite that pure exposure. And then the Russell, the small caps, was up 6%. So it was the top performer for the week. And we've seen this small cap strength. And a lot of it's related to what's upcoming for November, because in November, small caps perform to like 5.1%. So on average, again, there's no guarantee we get that again. This is just context, is probabilities. But I also think it's important to look at where are we year to date, because we know we've all plunged into a bear market and then we're kind of like still in it or not in it anymore, depending on the index that you're following. So starting with the worst, NASDAQ is down 29% for the year still, year to date. And next is the S&P 500, down 18.2. And this is now after this bounce, right?
Mm-hmm.
And Russell's down 17.7. And then the Dow Jones is only down 9.6. So, it's gotten above that 10% down scenario, right? And that's just because of the incredible performance for the month of October, which is one of the best performing months on record for the Dow. And it erased completely the sell-off in September. So the Dow Jones has completely erased it and is above that, where the others haven't completely erased it yet. Make sense?
Mm-hmm. Interesting.
Okay, over to you.
Yeah, I mean, in the coming week, we have 3 seasonality almanac events coming up. Tomorrow is the last day of October. And then
Right.
we have Tuesday will be the first trading day of November. And then we have the first Friday of the month as well. So there's 3 different key points there to look at the almanac this week. And I just want to look at some of the sectors that might do well on the last day of October. And for the month, we're expecting 0.79 for the spiders in general. But the last day, things that could be better as longs are utilities, the chip stocks, SMH, industrials, the oils, XOP, XLE, basic materials, technology, discretionary, QQQ, and things that might be better shorts or XLC, communications, gold, biotech, silver, the ARK-K funds, staples, real estate, and financials, and small cap. So there are some sectors to play against each other from the almanac perspective for the final day of October. And then Tuesday is the first day of the month, and it's kind of flipped. Again, things like biotech are expected to be better the first day of the month, gold, energy, chips. So it's whatever's down one day can flip the next day, I guess, in terms of first day of the month, last day of the month. So that de-risking we usually see on the last day. We'll see if the Friday rally continues tomorrow, but if we get the normal kind of pattern, it's a little softer that final day as people de-risk. And it is the last day of October. A lot of funds kind of close their books and whatnot. So, and then on Friday, the first Friday of the month, again, it's kind of mixed. Again, a bit of a risk on kind of theme with ARK-K up there, biotech, chips, a little bit shorter on some of the utilities and safer stocks. So you do have some themes to play there. And I have some data there in terms of how the months have done. You want to go over that in terms of small caps versus large caps? And
Sure. Go ahead.
Yeah. So if we look at a 1 month perspective, small caps have vastly outperformed mega, 9.29% up for the small caps versus 3.88 for mega. And on a 1 week perspective as well. And even on the 3 month, even though small caps are down 3%, mega is down 9%, right? So there's this outperformance we're seeing even before November, the small rotation into small cap. On Friday, it just happened to be super strong mega cap, but if you look at the 1 week, 1 month, 3 months, you can see that. And then also in terms of sectors over the last month, energy, industrials, and financials have been the best sectors, while consumer cyclical, communication services, and utilities have been the weakest over the last month. So if we still keep that kind of perspective on there, what sectors might keep pressing performance? It could be energy, financials, industrials. And then, I mean, you talked about overly shorted stocks before. Might want to look into that. And it's a full week, and beginning of November especially, that rotation into small caps could be pretty interesting.
Right, and you know, they've already been factoring some of that in, and you know, that could dampen it a little bit. It depends on what happens with the FOMC meeting on Wednesday. You know, we've baked in the 75 bips. Now, if we get it, that's as expected. We could still rally on that. It depends on the testimony then, which starts, you know, half an hour later, and see what happens with the testimony. The language that we're looking for is, you know, is there a different runway than what was previously communicated? Are we, you know, going to be talking about maybe a wait and see game for December and not actually raise, or are we talking about 50 or, you know, a quarter? The PCE numbers that came out on Friday seem to support, you know, continuing to target inflation. The other reports that came out didn't really, you know, make it change that much. But I mean, the argument is still there to continue the hawkish approach. But the market rallied recently because treasuries, you know, had some change. The US dollar pulled back a bit, and the market was just kind of very, you know, hopeful that the Fed isn't going to be as hawkish. So this is the great question, which hopefully will get answered on Wednesday. So it's really hard to know how the full week is going to play out with that snap dab in the middle of it. Plus, you know, could that change the outcome for the month? It certainly could.
Mm-hmm.
You know, it's and we also have midterm elections coming up on the 8th, right? So we've got you know, we've got a couple big events here, and this November meeting, you know, has been widely forecast and telegraphed to the market that, you know, so I think it's a critical meeting. And now we had our big sell-off in September, and we've had a bit of a rally back here this month. And so, you know, is this a bear market bounce, or is this the bottoms in and we go up from here? You know, the other concerns globally, you know, with Russia and the Ukraine war, with you know, what's going to be happening in Europe, and then with North Korea testing, you know, ballistic missiles, and then you've got this announcement that, you know, we have very low diesel stocks in the U.S., which is what everything is driven on, is diesel, right? Powers everything, all your shipping, all your, you know, trucking, everything, buses, everything runs on diesel. So if we're going to be short supply or out of stock altogether, what's that going to do? And that's supposed to come around the, you know, middle to the third week of November, where we have this crunch. Mm-hmm. So there is still some concern. So you know, I can't say 100% that we can have confidence that the bottom's in, because this whole winter story has not yet played out. And we're also would be saying it ahead of the midterm, and, you know, ahead of the FOMC sort of forward guidance here, right? So I think we have to just be respectful that the market got discounted. There was some cash. More money flowed into money markets, or back into funds than had previously. So this year there had been a bit of an exodus on a lot of the funds, and now money's flowing back into the funds. So that money gets deployed, gets put back to work. There was cash on the sidelines. There was people, that manage other people's money that were chomping at the bit for wanting to put some of it into these discounts, and we've seen that. So how much is left in the tank as far as that buying spree? I don't know. But we can kind of identify why. If you have a break on the yields, right? The yields were, rising and pulled back a bit. So that gave the market a bit of a relief. The US dollar pulled back, that gave some relief. Cash being put to work, money flowing back into funds, gave the market a nice upside move here. Technicals were pretty good.
Well, it'll be interesting if the FOMC does any kind of changes come this week, because the markets come back up. Are they really targeting inflation, or now they're going to be upset that the market's rallied? Or are they going to target the market? So if they were to be,
I don't know. I don't know that they would want to. I mean, I can just see that it's probable. I mean, you can't say how it happens, but it's probable that the Fed is maybe supportive of the current, administration, and wanting the midterms to be favorable to that administration. So, kind of an unspoken rule, perhaps, that they might be a little bit more lenient in their communication, or cautious in their communication. And because that meeting's right ahead of the election, right?
Mm-hmm.
So I'm not saying that Biden goes over and says to Jay Powell, hey, go easy on us. I'm not saying that. I'm just saying that it would be kind of an unspoken rule, that could be happening. So anywho, I think that we have.
How about the overly shorted stocks? You've been watching those the past week or two.
Well, I published that list to our group of things that had really high short interest, and whenever the market is a risk on and sort of sentiment is improving, some of those stocks really pop. They just go on a tear because they're already very high short interest, and you could continue with that theme, for as long as it sustains itself, which I can't see the market really wanting to pull back too much in the next 3 days, because we're prior to FOMC. So then after that, there could be a bit of a pullback, and then we've got the election thing. And then November in general has really good breadth for the market, and usually fires on all cylinders. So the way that the almanac reads is tremendous support, which then favors again these high short interest stocks that may end up getting squeezed for a variety of reasons. You can't pin it on any one thing. It's just that people may be inclined to cover, may think the bottom's in, and the reasons for their previous shorts are no longer valid, or worse, they are ganged up on again, and we get a bit more of this meme type trading going on, which is always possible when things come into a risk on approach. So anyway, now one thing I'd be looking at, potentially the Dow, which has been so strong relative to the other markets, and in the context of October, not just this last week, which Russell was the leader in the week, but in the whole scheme of things, and that was largely defensive, just like the move into the dollar. So I could see that we get into November and those defensive things kind of hold back, and I could see the NASDAQ, which is down the most, really, ripping up. So just be aware of that tension between the like year to date, the Dow's only down 9.6%, where the Nasdaq's down 29%.
Mhm.
So think of that tension. If the risk on really comes into play and they're willing to buy these Nasdaq stocks again, that could scream up much more than your defensive stuff. And this is how, when people don't watch for that, when they don't read those tea leaves, that's how they get burned, and they don't take advantage of, you know, the moves. Case in point is, why do we hedge? We hedge because we want to de-risk. We want to take the unknown types of events out of the equation. We hedge when we step away from our computers and can't watch things. But if you can read the information that the market's giving you, why do you need to hedge to the extent that you're completely offsetting? Right? Think about that. Look at the Russell's performance on Friday, which was choppier than the Dow, Nasdaq, or the S&P, which were much smoother ride, because Russell opened up and rallied and then pulled back all the way to the previous close. So it did fill the gap, and then it kept on going up later. The other ones, they didn't pull back. Nasdaq opened slightly discounted and rallied through and kept going and pulled back to the VWAP. Dow Jones just took off from premium and never looked back, really. S&P rallied also from pretty much a flat open and pulled back to VWAP. But again, the Russell was the choppier one, but nonetheless, it still rallied. And so my point is that if you had Russell stocks long, even a basket of 20 from, like, say, StockOdds, produced 1.75% return on capital for the day. If you'd hedged it for the day, open to close, if you'd hedged it, right, was 1.75 or 2.75? Hold on, let me check here. I'll just check while we're on the subject here. Yeah, Russell, the top 20 pulled in 1.79%, which is great return on capital. But if you were hedged, it was minus 0.03. So just pretty much break even, let's say. Mm-hmm. My point is, can you glean the information that the market is giving you without forward thinking, without trying to predict, without being speculative, without, being wishful? Just read the market and not overhedge, right? Not overhedge. Pull back on the hedge. Don't hedge at all if you can get away with it, right? That way you can get the better returns from the days that are giving it to you. Now, of course, if the market's really soft and starts pulling back, or you have a massive rally which is then starting to weaken, that's when you can move to the beta adjusted hedging, so that as it pulls back, you put your hedge on at an optimum level. Mm-hmm. And if you move to beta, you're really optimizing that pullback. This takes smart thinking in order to use your hedges strategically or not use your hedges. Right? But again, left to chance and you have to step away. You don't want to gamble. You want to make sure because things can happen. If you're there, risk is cut. It's not completely eliminated, but it's cut. All right. Hope that helps.
All right. Good luck in the week
ahead.
Catch
you later, Gator.